All right, everybody. We hope all of you who are our listeners in the US have been enjoying a nice long Thanksgiving weekend. We're back at work with a great show for you. First, we're going to talk about bet sizing on VC Sunday School. How, when you're thinking about structuring your fund, you decide how much to put where and how to maximize, of course, those big power law returns. Then in This Week in Climate Startups, we've got Ben Birnbaum of TeraWatt and Keyframe Capital joining to talk about how to supercharge commercial EVs, raising $1 billion in the Series A, starting a venture capital firm while running a startup, and much more. Stick with us.
This Week in Startups is brought to you by OpenPhone. As a startup founder, a lot of mistakes are easy to roll back, but using your personal cell phone number as your company number isn't one of them. OpenPhone makes it easy to get business phone numbers for you and your team, right on top of your existing devices. Visit openphone.com/twist to get 20% off your first 6 months. Odoo is a fully customizable and fully integrated suite of business apps that lets you build and scale your stack as you build and scale your business. Odoo is now offering all of their award-winning applications, services, and maintenance for under $25. To learn more, go to odoo.com/twist. That's odoo.com/twist. And House of Macadamias is the next big health trend. Get 20% off your first purchase at houseofmacadamias.com/twist by using code TWIST20.
All right, everybody. Sunday, time for VC Sunday School because the learning never stops. And today...
Hope everybody had a great Thanksgiving.
Oh, yeah, right. Sunday.
Thanksgiving Sunday.
Happy Sunday, everybody. I hope you're just like eating pie and relaxing, and maybe the family.
Pie. You should be down to the last slice or two now, right? If it's Sunday, you got like maybe one slice of pecan pie, like maybe half a crust of the pumpkin pie.
You don't do 2 dinners? We do 2 dinners.
There's no mashed potatoes.
Like a Saturday.
If you got mashed potatoes or stuffing left, yeah, something's wrong. You should have killed that on Friday, Saturday.
You should have made that into a proper shepherd's pie by now.
For sure. Ooh, strong move.
Oh, always.
But let's get to work. You have a question for me.
Yeah, enough goofing off. It's time to get back to work, people. It's Sunday. I do have a question.
Yes.
So, I spend the whole first year learning like when you decide, how you decide to make a bet, and then where you want to bet, and why you want to bet. And then all of a sudden, in one of our investment team meetings recently, came not just do you make a bet? And if so, how much do you bet? But specifically, how important it is to determine how much you bet. This idea of bet sizing.
Yes.
And I'm not a gambler, so this is all new to me.
Correct. So let me explain it to you. You have a certain amount of money to deploy, and you want to get an idea based on the power law, right? We've had Sebastian on, and we all know about the power law, the Pareto principle, 80-20 rule. In our industry, 1 or 2 investments will define your career as an venture capitalist. 2 or 3 investments, or even 1, will define the returns of your fund, right? That's the nature of our business. You get a lot of zeros. So we were on a call, and I thought I would explain this in a Google Sheet. So here, I'll pull it up. You really need to watch this one, but I'll do my best to explain it, Molly. I have 4 scenarios. Now, these 4 scenarios are going to be based upon how many 10x bets you make, how many 100x, 50x returns you get. So it's the same number of bets, right, Molly? 50. 50 times 250K each, right? So you're investing in a company. Let's say it's a $5 to $15 million startup, a value startup in the seed stage. You can put it at, 8 million on average or something. You get 2 or 3 percentage points ownership in the company. And here we have the outcome of 0. So in this scenario, I said 30 of the 50, 60% of the companies would return $0. It might even be 40, right? If you're investing very early, you get a lot of donuts, you get a lot of zeros, what we call a failed experiment. Fair enough?
Yep.
Pretty straightforward. Okay,
that's what I've been told. A lot of baby turtles don't make it.
They don't make it, sadly. But we look at them as experiments, and if the founder learns something, we will invest in their next company, in the next fund, right? And that's some of the great investments of all time. Uber was Travis's 3rd company. Superhuman was Raul's 2nd company. So, 2nd, 3rd, 4th time up at bat, you could hit a big winner. So here we go. How many of these return 1 times your money? So we're going to say 12. 12 of them return 1 times your money. You get your money back, right? So 12 times 250 is $3 million. So now you've returned $3 million of the $12.5 million in direct seed investments that you've deployed. Okay, you're still $8.5 million in the hole.
Mhm.
Now let's say there's a couple of 10Xs in there. Let's say 14% of your companies return 10X. Well, 10 times $250,000 is 2.5, 7 times 2.5, 17,500,000. And let's say you have 150X in the portfolio. Oh boy, yum, yum. You hit some outlier and 50 times $250,000 is 12.5 million, right? It was one of the 50. That's why I did 50X here, right? So you could actually see one pays for all the principal, which means you had approximately 20,500,000 in profits. So if we look at the end, you returned $33 million, which is a multiple of 2.6x, right? So cash on cash, 12.5 million went in and 33 million went out, right?
Yep.
Extraordinary. That is an incredible outcome. Congratulations. You probably beat the market, right? Mm-hmm. Now, if I were to delete this one, that was the outlier, you're now 1.6, right? You barely returned more than you put in, right? So the outlier really matters. In scenario 2, we have a very similar setup. 30 companies went to 0, 12 companies returned the amount of money you invested, 6 returned 10x, 1 returned 50x, but we added 1. We added a 100x. So $250,000 investment became worth $25 million. A true outlier, right?
Yeah.
Damn. Now your fund is at 4x plus in terms of cash on cash return. You're a hero. Now you're like, really top percentage of your industry. And let alone if we did a scenario where we added a 200x, which does happen, right? And that would put you at 6x. Now, if you happen to hit a 3000x, which is what like an Uber or an Airbnb could have been worth, depending on the timing and the public market value.
Yeah. You
hit 2 of those, let's say, and you have 6 of the 200x's, you have some Sequoia-like benchmark, like you could have and this would be historic, but 100 times cash on cash return. Not going to happen in all likelihood. So I put maybe 1 at 3,000, 0 at 200x. But even still, if you hit a 3,000xer, which has happened with a Google, an Apple, a Facebook, an Uber, an Airbnb, potentially you could have 1,000, 2,000, 3,000x return, and you could have a fund that returns cash on cash 10, 20, 30, 40, 50, 60 times money. So this is what people are betting on. They're betting as an LP, when I invest in funds, that I'm going to hit one of the first 2 scenarios in all likelihood. Maybe I'll even, only return 1 time my money. I'm fine with returning 1 times my money. I get my money back. That's for me as a gambler, totally acceptable, especially if there's a chance that I could have a 6x or a 10x or more return on my fund investment. Does that make sense?
Right. It does. So then how does that impact? What about that's the betting, but then what about the sizing part of that? Does this concept influence how much you want to put into different companies based on where you think they're going to end up in that column?
Well, we're saying here 32% of the fund's, $39 million in deployable capital is going to these first bets. Now, in this scenario, I also talked about our accelerator. I talked about Founder University, one of our new products where we invest small amounts of money. But let's look at follow-on investment. Here, I've said we're going to leave 38%, even more for follow-on investments. And in this scenario, we'll do 60 bets because we have an accelerator and we have Founder University. 60 bets of $250K, which would be 15 million of the fund. And so if some of those hit, and those ones you should have a higher hit rate on because you know more about the company, it's a follow-on investment, then you're going to start to see another profile of returns that could be very accretive to the fund, right? And that's really my philosophy of early stage investments is place a lot of small bets and then have a lot of cash reserves to bet more. Now, some people might say, hey, you should have, 60% on the first bets, 40% on the follow-on, 70-30, who knows? Mm-hmm. And that's where the art comes in. You might have so many companies that are doing so well that you don't have enough reserves. You might have a situation where you have all these reserves, but you don't have any winners. And then you run into a winner that's not part of your existing portfolio and you just bet it all on, what would be Uber's or Airbnb's Series B or Series C, because you're like, okay, we didn't find a rocket ship in our primary investments. Let's go externally find a rocket ship. And so these scenarios can be back tested against your previous fund's performance, right? So you could look and say, well, in my first 2 funds, how did I do? If your funds are in fact 7, 8, 9, 10 years old, you'd actually be able to back test this. And then you would look at your performance in that fund and say, oh, what if I had done more follow-on investing in these, right? What if I had done more primary investments and less follow-on, right? Did I get my follow-ons correct? And this is where you start to build the discipline of, oh, we really need to focus on, putting more money into the winners. And that's where almost all VCs wind up. We have to figure out how to get more money into the winners.
Amazing. Awesome. Love it.
And you can bet sizing, very simple.
Not just how much you have, how much of it you're going to deploy the first time, how many companies, how much you're going to save for the follow-on. Love it. It's also, it's so many more spreadsheets to learn.
And well, the great thing you can do is you can actually then track yourself. Now, so this becomes a bit of a plan, right? So this would be as if a poker player said, okay, I'm going to play in this many tournaments. I expect to cash in this many. And then I'm going to play in this many cash games. I expect to have this return profile there. And I expect, this many tournaments, I'm going to go to 0. This many, I'm going to return 1 times my money. And this many, I'm going to return 5 times my money. Over this amount of time, it's going to take this many hours of play. And they can actually then do what's called bankroll management. You're managing your bankroll. It's the same thing here. This is bankroll management for VCs.
Rad.
All right, everybody, on the phone today is OpenPhone's founder, Darina Kulya. Welcome to the program, Darina.
Thanks, Jason. Great to be here.
What about the situation where you have, a phone number that's a common number? So customer support number, or maybe you wanted people to just be able to call you and generally talk to the sales team. How do you handle that when you have a group number, a shared number?
That's actually one of the super unique things about the way we've built OpenPhone is that we allow you to have a shared number for your team. First of all, when you call into that shared number, you can set round robin if that's applicable, or by default, everyone's phone would ring. The first person to pick it up will be able to have a call.
Ooh, I like that for customer support. Wow.
Exactly. And also, if I'm on a call with a customer, I don't want to be interrupted. There are other people who can pick up new calls coming in. But I also really think what's very cool is that this workflow works as well for text messages. And not only can you just share responsibility for responding to text, but you can also use this as a training exercise, because the way that it works is that if I am a customer support rep, there is a text message from a customer, I don't know how to answer, I can actually tag my teammates privately on that conversation and get help and say, hey, is this okay to say, or how would you respond?
Okay, everybody, Twist listeners can get 20% off any plan for their first 6 months at OpenPhone. Just go to openphone.com/twist. If you got an existing number, they'll port it right over for free. Head to OpenPhone.com/twist today for 20% off.
And then, of course, it would not be Sunday without This Week in Climate Startups. This is a really interesting one. We've got Ben Birnbaum. He's the co-founder of a company called TeraWatt, which is working on these charging locations for EVs that would basically be built around fleets. They would provide massive jolts of electricity to commercial fleets and vehicles that are, and fleet owners that are trying to switch to EVs. And that is so expensive that the company itself ended up basically spawning a venture capital firm. So Ben is also a partner at Keyframe Capital. TeraWatt got over $1 billion in a Series A to build out its portfolio of these commercial charging centers. One of its investors was Keyframe Capital, and then this other company, Cyrus Capital. It's just a very interesting look at how much capital it's going to take to build out big time commercial EV infrastructure, and how sometimes you might need your own VC fund to invest in that and others trying to do the same thing. Here comes Ben Birnbaum. Enjoy. Ben Birnbaum is the co-founder of TeraWatt and partner at Keyframe Capital, which builds, and TeraWatt builds electric vehicle charging infrastructure for fleets, which is the high level description. Can you break that down? Do you have 2 jobs? Are you also in VC?
Something like that. Yeah.
Okay.
One.
Tell me more.
Kind of naturally led to the other, but I think you nailed it. But we'll get there in time.
All right.
But yeah, thanks for having me.
Yes. Welcome to this.
Where should I start?
Start with TeraWatt, because $1 billion raise is nothing to sneeze at.
Yeah, we're excited about that. So I'm a partner at Keyframe. I kind of have one job, but at this point, because we have a fantastic team at TeraWatt, and it's led by a CEO, Neha Palmer, who was the ex global head of energy for Google.
Mm-hmm.
But at a point, it was two until she joined. But yeah, so I'm a partner at Keyframe, which is an investment firm that me and a couple of the founders of TeraWatt also started, but everything kind of happened in order. But we're a firm that focuses on energy transition. So excited about all the stuff that you're up to. We invest a little bit downstream of where you are. We've got around $1 billion AUM.
Let's talk offline.
Yeah, absolutely. But we invest sort of thematically across that, and we grew sort of very naturally out of TeraWatt, which is at EV charging and specifically fleet charging hubs are kind of at the cross section of so many different energy and infrastructure needs. And I'll tell you about, we're building that business, but that business ended up for us being, needing to build an investment platform. But
all right, that is definitely not something that you hear that often. So let's take this chronologically.
Well, it wasn't intentional at the very beginning, but I'm excited that it all happened, and I'm excited about where both businesses are going.
Okay, so it sounds like TeraWatt came first.
TeraWatt came first, for sure.
So tell me about that and that business.
Yeah, so at its simplest form, I'll tell you what it does, and then I'll tell you about how we started it.
Mm-hmm.
So at its simplest form, we buy real estate and redevelop it into charging hubs for fleets of electric vehicles.
We should jump in here. By fleets of electric vehicles, you mean not consumer vehicles? This is like...
Yeah, not personal vehicles. And, think very simply like the Postal Service or FedEx or Amazon or bus depots or things like that. But the reason that we do that, the reason why we feel like it's important for businesses like ours to exist is when you plug any number of pieces of equipment that consume a lot of electricity in at the same time, at the same place, which a commercial vehicle has a much larger battery than a personal vehicle. So think like picture in your mind a Tesla Semi or the Amazon Rivian vans have started to roll off the line and are out there in the world versus your sedan.
Yep.
They pull a lot more power.
Yep.
And plug 200 of them, or a bus, a municipal bus, plug 200 of them in at the same place at the same time. And you can use, this is not a hyperbole. You can use as much electricity as a skyscraper, and not like a baby skyscraper, like the Empire State Building.
Like the Salesforce Tower. Yeah.
Yeah.
Okay.
Like this. I have the Salesforce Tower and the Empire State Building are on pitch decks somewhere. And there are many, many locations out there in the world that have 50 to 400 or 500 vehicles. Think logistics centers, or garbage trucks or taxi depots or things like that. And, those places were not cited for their ability to get that kind of power. And so they were cited for their ability to meet the transportation need.
Right.
And so the very short decision tree that every one of those businesses has to go through is, do I develop new infrastructure out to my site, which is takes a long time because you have to deal with the utility and is expensive and is a complex engineering challenge?
Mm-hmm.
Or do I move to a new site that has enough electricity capacity to serve me as a electrified fleet? The answer is both.
Okay.
The answer is both.
I'm like, both of those sound really hard. One of those doesn't sound significantly easier.
Both of them are not good. Are not good options.
Right.
I mean, they're not necessarily like bad options, but
they're better options than not electrifying.
Yeah, sure. I mean, if you're the fleet manager of a taxi service, I think you're doing what the company says, and you have to figure this stuff out. But they are for sure complex, and changing operations is a complicated thing. But TeraWatt works with companies who operate fleets on both of those things. We both develop out sites for our customers, and we are acquiring sites that can be redeveloped. With the hardest part is getting enough power to sites. So we're acquiring sites that have the right characteristics from existing infrastructure and ability to bring power there with the utility. So we're both working with our customers on their existing sites and acquiring sites where we can serve customers on the timeline that they need. And
so what goes into that? Because it sounds like a real estate development business.
Yeah,
with a specific thesis, but maybe not an obvious venture backable business, which obviously we're going to get to because it is so much that it spawned a venture firm.
Yeah. Well, it's venture backable is a that's a term for interpretation.
It might be loaded.
I'll
grant you that. Yeah. It sounds expensive, I guess is what I'm saying.
It sounds expensive, and our business is capital intensive. Yep. And, Morgan Stanley or BNEF will tell you that the US needs somewhere between $500 billion and $1.5 trillion of this infrastructure, by 2040. And so that is like $1 billion is like not nothing compared to the TAM. And our business is to consume. I mean, our business is to deliver infrastructure for our customers, but our business model is to consume capital. You asked two questions, but the second question was, how is it sort of backable as a business that can continuously scale?
I guess maybe
the venture question.
Yes, I think I asked that the wrong way, which is like, what is the technology that goes into it? Is it primarily a construction task? Is there energy management? Are there batteries? Like, what happens at these sites?
Yeah, so I think it's separated into two things. The first, I'll just sort of finish my thought. Part of our business is to consume capital. And we need to be set up in a way that we can like continuously consume capital at scale. And the second thing is, there's a technology overlay, and that's entirely software based. There's a lot of hardware out there from awesome companies, like everyone from large incumbents that serve all different types of electronics, like ABB, through new folks like ChargePoint, and at a charger and like EV equipment supply level and battery level, through like site construction and operations level. It's not really it might be just like a solar developer's role is to participate in procurement in some way. It might be our role to like help with the coordination of that, or have at our own sites some preferences for engineering design. But we don't have any innovation in that. There's larger companies that are and have invested a lot of money in all the components that you need for sites to operate well. Our technology is fleets need like site reliability and like cost and availability of power. And it comps actually pretty well to data centers. And actually the entire business model comps pretty well to data centers.
When you say comps, do you mean in terms of cost, build out,
in terms
energy
of
usage?
Well, all those things, but when you look at like the answer to your question of like how we set ourselves up and what's the kind of technology that we need to provide, we looked a lot to companies like Equinix, for example, who develops data centers and then has the technology that keeps, the data centers consume a lot of power, and they need to have like incredibly high reliability so that when you and I want to watch a Netflix show on a Tuesday night, we can, and it doesn't have any, buffering or anything like that. And so there's like really high SLAs. Like it's like when Amazon needs its fleet charged, it can't have delays because, and it needs availability of power. And, I don't know how wonky we should go here, but if power isn't managed properly, cost swings can be, can be pretty significant. And so we have to have the software that manages this stuff across lots and lots of different hardware and complex operations at a site, and often multiple tenants at a site, which is very similar to a data center. And so that's our software overlay attached to an asset owning part of the business.
Got it. Yep.
Looking for a better way to manage your company without tons of expensive, disconnected software? Then you need Odoo. Odoo is an affordable, all-in-one management software with a massive suite of fully integrated applications designed to handle any unique business need. Sounds great, right? Well, it gets even better. Odoo is now offering all of their award-winning application services and maintenance for under $25. That's right, for less than $25, you get 100% of Odoo for 90% less than the average market price. And Odoo is so much more than a world-famous ERP, that's Enterprise Resource Planner. Odoo has over 80 applications for everything your company will ever need. We're talking CRM, marketing, accounting, manufacturing, inventory, you name it, Odoo's got it. So, as your business grows and your needs change, Odoo will be there every step of the way with dozens of user-friendly solutions to choose from, and you get it all for under $25. To learn more, go to odoo.com/twist. That's odoo.com/twist. Get more done in less time for a fraction of the price with Odoo.
And are you actually in just to like wonk out a tiny bit, are you in the energy procurement business? Like when you pop up these sites, you're clearly trenching but sounds like you're optimizing the energy use.
Yeah, it's a little
but are
early
you also
for me
signing
to,
like PPAs or?
That's a thing that that probably will do, but like I don't like right now. We're like in like a walk before we run situation, but we will do stuff like that to optimize energy cost and as well as like help our customers get to net zero. That's not the kind of thing that customers are like really focused on right now. They're focused on like something I didn't get to say before, but there's been this promise of EVs since, I don't know, 2012, 2016, 2020. And like now they're actually being delivered. And now people are just kind of scrambling for, oh my God, I need a charging solution and I need it now. And the SLA asks and requirements and contracts are more related to uptime and reliability than they are to than they really are to any level of. They're more transportation oriented than they are energy oriented so far. I'm very excited for them to be any energy oriented, but I'm not surprised for that to take some time to catch up. But our CEO is the woman who took Google to net zero. So she'll do it for transportation as well.
Yeah, I mean, not for nothing. That was a huge signal to lots and lots of industries. Okay, so one last question about TeraWatt, and then let's move to how it spawned the firm where you're now a partner. I would imagine that TeraWatt came out of stealth in 2021.
Yeah, that's right.
And then infrastructure bill passes, which has lots of climate incentives. IRA passes, which has lots of climate incentives. Like, it feels like you must be thinking it's a great time to be in this business.
I mean, in 2017, when we started the business, it was like not consensus that electric vehicles were going to be a thing.
Let alone electric fleets.
Yeah, I mean, there are less people that are skeptical now, but there are still some skeptics of that. I have some good investor rejection stories from folks who are now heavily invested in, big EV SPACs and things like that.
I see.
Who were big automotive, career automotive folks who were like, this is a waste of time because vehicles aren't going to go electric. So I don't know why you guys are doing this.
Yeah.
So just, yes, excited about the things that have happened over the last year, but relative to 2017, like, we were buying property that had good interconnect, and some people were like, what are you doing with your lives? So, the last year,
turns out,
I think the IRA is so exciting for energy transition in a lot of ways, but I think for vehicle electrification, specifically for fleet electrification, it's kind of more like a rising tides thing. There's there's a couple of tax credits that are nice, but we're already moving at max velocity because of what I said before about the timeline for infrastructure development. I mean, it takes 18 months to 2 years to develop anything material. And the IRA has not addressed anything about, permitting, or didn't give any additional resources to utilities to work on, interconnection queue backlogs or anything like that. And, I think having more public charging stations out there and more people driving EVs will bring positive sentiment to the fleet manager that I mentioned earlier, who might, not have been that interested in the conversation earlier. But there's significant blocking and tackling that has to happen. So yeah, I mean, it's early days in a market that is just like so big and exciting. So yeah, I feel lucky and excited, and it's a really fun team to be working with. Yeah. So I don't know what's EV in the
right place, right time,
the climate syndicate yet, but hopefully you have some
still early
fun things as well.
Yeah, exactly. It's still early. Okay. Well, talk to me about, speaking of our future co-investments, how TeraWatt spawned Keyframe Capital.
A lot of things were happening simultaneously. So this is a little 2020 hindsight, but our first 3 years, we were buying property around the country with the thesis that I described, that there was going to be constraints in where, and there was going to be a real need, and there was going to be a real benefit to being able to deliver that quickly. And so if we could get a head start on things like preliminary designs and getting site control, that we would be able to, be in good position for the, market opportunity when it presented itself. Mm-hmm. And so, and we weren't exactly in stealth, but, there weren't really customers to talk to. We were going to all the conferences and we were telling people we're buying property and we're interested in fleets. And they're like, you're doing what? Like, I don't understand the connection. And so to our investors' perspective, as you kind of rightly noted, there's obviously there's a corporate element to what we're doing, but there's also like a real estate, acquisition and development angle to what we're doing. Mm-hmm. And so to our investors' perspective, we're purchasing some assets with a thesis around energy transition, which, and we had to raise appropriate capital from the appropriate sources to be able to do that. And so they were interested and, would keep tabs on us and keep tabs on market opportunity. And they would, had kind of seen us as folks in the energy transition space and were kind of pushing us on, what other kinds of assets were out there like that. And then simultaneously, we're having these conversations with fleet operators, and we're talking to a Fortune 10 head of transportation operations. Mm-hmm. And the properties we're buying were like metaphorically, think like the property next to an Amazon distribution center. And imagine if Amazon came and said, hey, can you give us a proposal for what charging infrastructure, like what a turnkey charging infrastructure would look like on the neighboring property? This sounds really interesting. And at the time, our team was just, I didn't get to tell you my team's full background, but our team was just pretty lean and mostly just focused on acquiring real estate until the market opportunity really presented itself. And mm-hmm. It was at that point that we felt like, wow, we really have like product market fit with just like the land that we've bought. Or we kind of called it land market fit. And we felt like, yeah, absolutely, we'll like bring you a proposal. But then we came back with ourselves and we were like, wow, to be able to deliver a proposal that scope, we're really going to need to build out the rest of the company. And that's when we sat down with our investors and talked about what was going to look like. And also sort of talked about what I said before about, their interest in the work that we had done over the past couple of years, acquiring, assets with this differentiated point of view. And that's when we made the decision to recruit a team with the capabilities of like delivering on that technical vision while we continued to build the fund and be able to back them in building the business and, and ultimately invest in other businesses like it.
All right, listen, my favorite nut, macadamia. My favorite chocolate, dark. Now I have in my office a nice box of macadamia bars in dark chocolate, and I got dark chocolate covered macadamias. A perfect snack for JCal. I get a nice cup of black coffee and I treat myself. And that company is House of Macadamias. The founders of this company, Brandon and Carmen, they've been listeners to this podcast, This Week in Startups, for a long time. And they told me, I kid you not, that they started their company after they were listening to This Week in Startups and they read my book, Angel. They used the returns on their first angel investment, I kid you not, the story is amazing, to start this macadamia nut business. And look, all nuts are not created equal. Here are the health benefits of macadamias compared to peanuts, almonds, cashews, and walnuts. Macadamias are high in omega-7s, which have been linked to fat loss, which I need, right? And natural collagen, so you look nice. They also have more healthy fats and less carbs. Every product is vegan, keto, and paleo. Since you probably have 2 or 3 of those on your list. Take it from me. I eat these macadamias all the time, every week. 2 or 3 times a week I eat them. They're delicious. It's my little treat for myself. And again, for me, it's dark chocolate. For you, it might be one of the other flavors. They got spicy nuts. They got sweet nuts. They got everything. They got ones that are spicy and sweet. Here's what I want you to do. Go to houseofmacadamias.com/twist right now. Get 20% off by using the code TWIST20. That's code TWIST20 for 20% off at houseofmacadamias.com/twist.
Wait, I still don't totally understand though how the fund became necessary. Was it in order to at least partially raise money from LPs in order to at least partially fund TeraWatt?
Yeah,
or
that's
was
right.
it? Okay, got it.
Yeah, so we worked on the capitalization up through the financing with Vision Ridge.
Mm-hmm.
And, to get all of TeraWatt's capitalization done, we kind of formed into Keyframe as a fund. And TeraWatt became what was our sort of first and one of our marquee investment positions.
And then how much did the fund raise?
Our first fund was around 250.
Mm-hmm.
And we now have a little over $1 billion.
Okay. And they're continuing to invest not exclusively in TeraWatt, like other EV infrastructure businesses?
We have over 20 companies in our portfolio.
Mm-hmm.
And we're broadly focused on energy transition at this point. We have specialists in a couple of areas. I would say where we spent the most time are building automation and energy efficiency, grid edge, carbon capture. We've made a number of investments in EV charging. We just made an investment in a multifamily EV charging business.
Oh, mm-hmm.
We also were investors in EV Connect that exited last year.
So it sounds like part of the thesis is a tolerance for hardware. Let's say.
I think we definitely lean into the complexity of the capital needs of energy transition. And I think maybe it was lost in part of my explanation, but something that our LPs really push us on and is, not necessarily to go out there and find assets, but it's impossible to deal with infrastructure out there in the world and have that not be related to your business in some way. And so whether we're a venture investor in a SaaS business or a David Energy or a Passive Logic or a couple of companies in our portfolio, or we're something more, or in Arcadia is another example,
mm-hmm.
or we're doing something more asset intensive with a C&I solar business like Wonder Capital, or an HVAC retrofit business like Redaptive. We try to, be more focused on thesis and thematic development, like we have had around fleet charging and why that matters, and less focused on, does it fit neatly within specifically traditional, venture sort of checklist might look like.
Mm-hmm.
Just because, that can be very difficult with energy and infrastructure. Just, assets it's impossible to avoid assets.
Right. Well, then tell me the background. What is the origin story that you alluded to? Where did this team come from, and how did you get interested in this specific problem, and then end up recruiting Neha to run it?
Yeah. So I was the head of strategy at a company called MV Transportation. From the look on your face, I can tell you're very familiar.
That is my polite, interested, tell me more face.
Yeah. So they are one of the largest public transit operators in the world.
Okay.
And I joined, I think I am the luckiest person in transportation. I joined what was a unique business. They operate the public transit services in 250 or so cities in the US and Canada. So that means cities outsource to a third-party operator like, DART in Dallas or the MTA in New York or whatever, in a 10 to 30 year contract, paratransit or their fixed route bus or school buses or whatever it is.
Mm-hmm.
Like the labor, the CapEx, the facilities, the technology, all of it, the maintenance services, all of it into a contract. And companies like mine or Transdev or First Group, there's a few big ones in the world, bid on them in 1,000+ page RFPs responses. And they're complex and a bit thankless of operations, but they could be $100+ million contracts.
Mm-hmm.
And I joined not for a deep passion of transportation nor infrastructure or sustainability, but like a private company with an interest of selling itself into private equity. My interests have evolved, but I was
going to say, pretty mercenary for a guy doing.
It was like, I was, in my mid-20s, and it was just like an exciting business opportunity.
Honestly, I wish I had been that strategic at that age.
Yeah. And, but I joined and it was like, I started to work on the assignment that I just described to you, and private equity firms were questioning. We had a $500-600 million paratransit business, and private equity firms were questioning. It was like 2015 or something, and they were questioning. There's this company Uber is growing like crazy. Are they going to just like replace your entire business? And so I was having to learn those things for private equity firms and then go work on, okay, I got to do a deal with Uber to prove to these private equity firms that we have a right to exist in the world.
Mm-hmm.
And that was, I don't know if you remember this, but that was like the time when mobility VC became a thing. Yeah. And it absolutely exploded. And anybody with a PowerPoint deck that said mobility, AI, autonomous electric vehicles, like could get $5 million and start a company. Mm-hmm. And when I began to look at like vehicle electrification for our business, it was like kind of a little bit into Proterra's life, and people were starting to buy electric vehicles. And my job was kind of like, as head of strategy, was meet with mayor's offices and departments of transportation, understand their needs, and figure out how to get them into that 1,000-page RFP response in a way that brought in new technologies and fit the business model.
Mm-hmm.
And they started to ask for electric vehicles, and I realized, it was just going to change every aspect of our operations, change our maintenance operations, change what our drivers needed to do, change our site operations. And then I started to meet with people at contemporary companies, not competitors, but like just other fleet operators. They also had no idea what to do, and their staff had no idea what to do. And then I started to talk to a friend who is another TeraWatt co-founder. His name's Ethan Goldsmith, who was one of the earliest Rivian employees. And the two of us were, brainstorming a little bit about, and he was obviously very bought into electrification as a concept. And I'm easily excitable, so he got me even more bought in. And so we started making one of those slide decks, putting those buzzwords on there, and we were like, maybe we could start something. And then we meet our third co-founder. His name's John Rappaport, and earlier in his career, he had had brought all the capital together to start Virgin America. And
Right. I knew that name sounded familiar.
And he had done a number of things like that afterwards in transportation and energy. And we weren't sure why he was so excited to have conversations with us, but hey, we started brainstorming further with him. And Ethan and I had this absolutely horrible idea. We were brainstorming with John about it, and it was going to be a transportation service of like autonomous electric vehicles. And we were like, it was going to lose a bunch of money for a long time, which is not a thing someone should do for a business. And we were,
I don't know. Venture doesn't seem to hate that, but okay.
Yeah.
Keep going.
Yeah, for sure. For sure. And we were drawing out the infrastructure, like the hubs that these vehicles were going to need to like charge at and depot at, and what services were going to need to be there, and where they were going to need to be, and why that's where they were going to need to be.
Mm-hmm.
And then we started doing some math around what the charging needs were going to need to be. And then we were like, oh, whoa, that's way too much power.
Right.
Where could we possibly put this? And, for a little while, that was a big light bulb. And then for a little while, we sort of continued on with that plan. We were like, couldn't figure out how to execute it. And then, it just clicked one day that we could just buy the real estate and wait.
Mm-hmm.
And if vehicle electrification never happened, we could just sell the real estate.
You'd have good commercial real estate. Right.
And, no one would be that mad at us. We might have just wasted some time. And, then it did happen.
Right.
So.
Fascinating. All right. Well, what's, before I let you go here, I've taken up a lot of your time, but what's next? What comes next for either Keyframe, TeraWatt, both?
Yeah. So we have 9 months of runway. So, it's about $1 billion will get you with this much inflation.
Yeah. We should say that I don't think I specified this up front, but the $1 billion was the Series A raise, and that was completed. I'm looking.
A couple of months ago.
Okay. Yep. Uh-huh.
Yeah.
That's what $1 billion will get you.
It's
real estate. It's an expensive business.
Yeah. This is a grenades, not horseshoes thing. So it was at some point in the past couple of months. It's hard with the press releases versus closing. We're really growing alongside of our customers in what their needs are. And that's what's happening right now. So that's really what's next, is executing on development.
Where are the customers? Like where are the sites that exist now?
Our sites are fairly national. We own property in 18 states, but most development is happening where you would expect it to happen, on the West Coast. And we made a public announcement about a corridor we're developing on I-10 from Port of Long Beach in LA to El Paso in Texas.
Nice.
Every 100 to 150 miles. There's kind of two kinds of sites. One with proximity to customer locations, like I described before. And then, it's two between customer locations, more highway oriented.
Mm-hmm.
And ultimately,
so it's not just like home-based charging, it's on the way charging.
Yeah, Yeah. Ultimately, we'd love to have, great density in as many places as possible, but that's a long-term vision.
Right.
In the short term, it's focus on those couple of places where we have, solid anchor customers, and develop and try to deliver a good customer experience for them, and high reliability, which is, both physical development and the technology that I described earlier.
Yep. Amazing. All right. Ben Birnbaum, co-founder of TeraWatt and partner at Keyframe Capital. just doing it all in the infrastructure department. Ben, thanks so much for the time.
Yeah, really nice to see you, Molly.
All right. Thanks for listening, everybody. And thanks to Ben for joining us. And again, I hope you had a nice long Thanksgiving break. We will be back on Monday with the news. And by that, I mean tomorrow. We'll be back tomorrow. We'll have news for you. And if you haven't already, by the way, go check out our new podcast and search for Founder University in your podcast feeds, especially if your New Year's resolution is going to be make a new startup. This is what you want to listen to first. These consist of 20-minute episodes with super tactical talks. We're talking accounting, SEO, how to make a proper blog post. It's really, really, really helpful. And we hope that every single episode makes founders say, I need to show this to my team. Enjoy the rest of your day. See you back here tomorrow.